All right, Paul. So, how low are we going in this 10-year yield?
Well, if the world 10-year bonds are an indication, we could hit zero sometime next year. We could see those old lows probably over the next 6 months or so. There's nothing right now in the economic landscape that's pointing to strong economic growth that's going to force the Fed to raise rates. The markets are anticipating 3 more cuts. We're getting weak PMI data from around the world. And actually, if you average them all out, we're probably in a little bit of a contraction mode, slightly below 50. So there's really nothing that's going to push interest rates higher at this point. We're seeing energy prices come off. We're seeing a lot of the commodity prices come off. There's really no reason to see interest rates higher at this point, and certainly we've got the ECB talking very dovish, and we just had a rate cut from Australia this morning.
So, Paul, it's these, I call it like trends within trends, right? Because we've had now, for the past 2 weeks, some interesting developments, a little bit of dollar softness, some gold strength that took a break here over the last couple sessions. Now, today, the question is the next information we get from the Fed going to amplify those trends? Because it seems like if bond yields keep going down, then Fed follows up what the market wants. If we keep plumbing low yields, should we associate the bond rally with the potential softness in dollar, strength in gold? I mean, has the market changed that dynamically?
You know, it's interesting because, it was the part of the reason why when interest rates were falling and the dollar was still very strong, we were one of the strongest economies around. Our economy is weakening now along with the rest of the global economy. And with trade talk and trade tariffs still on the back seat, we're seeing a dollar that's starting to decline. And the dollar-gold ratio has really been an opposite. As the dollar's been stronger, gold has been weaker. We've now seen that flip. So I think if you do get an interest rate cut, you will see dollar weakness. You could see continued gold strength as investors have little financial reason, at least, to hold gold, because with interest rates essentially zero, there's no cost in holding gold. So you've got that, plus confidence in currencies in general is starting to come back off a little bit, and that too gives a little bit of a boost to gold. So with a breakout in the price above $13.50 or so, we could see gold run here much longer, I think, over the next 6 months or so.
Yeah. All right. So, Paul, with that said, I know you're a stock guy too, so let's talk stocks for a sec. The mover of the day is probably VIX in my mind, because now we're flirting with the 12 handle. We're at 13, finally getting a break below the 14.5. We've been in for the better part of these latest, series of new record highs, but yet there's not a big move in stocks pushing it down today. Is there something going on with the holiday week? Am I missing something on volatility here?
No, I don't think you're really missing anything. If you take a look at the volatility of the volatility, that's down near lows. It's about an 80 level, slightly below that. Historically, what's interesting is when you get to those levels, we get to the VIX down around the 12, 13 level, that normally is somewhere around the peak in the equity markets. We get a reverse in the equity markets. Where that could come into play is a bad number on the unemployment number on Friday. Holiday trading pretty thin this week. We may see traders come back with a vengeance next week if we get a poor employment report on Friday. But again, because the economic data isn't that great, equity markets are not reacting to it like they historically would at this point, figuring that the Fed has got their back right now.